Susan's just behind a closed door over here. And yeah, thanks for joining the session this evening. I know we're competing with a whole bunch of other life pressures. And for us, we're trying something a bit different this evening as well. Usually at ETFSA, we generally hone in obviously on what's going on in the ETF market and the various policies and services that we run. But tonight, Susan and I thought that we would really take more of a financial planning approach to it. And we've invited clients that really sit in kind of what we would call in financial planning the classical midlife part of their savings journey, and might feel a little bit like this toothpaste. Certainly, the toothpaste around my house feels a bit like this sometimes, and there are usually multiple tubes that actually look like this. And so we're going to have a bit of fun. We're going to talk about this stage of life, some of the financial planning headaches that one might be facing. And Susan and I have given some thought to some looking to implement around about this stage. So I'm going to kick off into the presentation. So yeah, my father often used to say there's for everything in life there is a season, and as you go through life, there are a whole bunch of seasons and time frames that one moves through. And I suppose Susan and I are well qualified to talk this evening because we both sit in this middle period of one's life where you are not new in your career, you well through studying, you have maybe not started a family, but you've hit kind of the midpoint of your career. And this is well documented, not just in financial planning, but just generally speaking, I think in psychology, as being quite a tough time in life because you've got often younger children or dependents that you are taking responsibility for, but you're also helping parents and older generations as they start to get older and require your support, even if that's not financial support, it might be emotional support and other types of support. So, one does feel like there's a bit of a squeeze on. And just to give you an assurance that, firstly, you're not alone. This is a very kind of common phase in life, and it's not forever either. At some point in time, you'll be that little icon playing golf and feeling in a slightly more restful state, even if it's not golf, whatever other life pursuit you may have, doing art or walking in the park, whatever that might be. But really, we want to talk to our client base that are feeling this midlife pressure and what does it mean from a financial planning perspective. These are your peak earning years. You may not feel like you're at peak earning yet, and that's great. Hopefully, you've got a lot of career growth still to come, but you're really starting to spend round about now on a whole bunch of things, and your responsibilities have really climbed considerably. And as I say, these pressures are coming from a number of different angles. School fees being, just one of them. One of the jokes Susan and I read preparing for this is that if only one's portfolio was performing as well as school fees were increasing by, that would be that would be quite a nice position to be in because every year you get that letter and it's well next year's school fees is going to be X% higher, and it feels quite daunting. Susan, I'm going to bring you in straight away just to say hello to everyone and get the conversation going just get from the get-go. Um, Maybe also you can share some of your background as a financial planner and so forth. Yeah, and take it from there.
Evening, everyone. Thank you for joining us. Like Gareth mentioned, it is a critical time. With the mothers, they're running around with the dads. They're trying to watch a soccer game or catch up on that. So
No,
thank
no.
you for spending your time. But certainly another thing I'll just quickly raise with you guys. Feel free to raise any questions as we go through the presentation. If there is a question that you sort of note in between the presentation. You can sort of note it in there, and then we'll deal with questions at the end of the presentation. But certainly, Gareth, with being in this middle life stage, that it's a make or break. You either make it and you make the right decisions, or you break it and you unfortunately learn the hard way, which is when you get to retirement and it's sometimes almost too late to make radical changes that could make an impact. But the importance of actually having our listeners today joining us at this stage and listening to this is so that you realize the power that you have, or what we call the financial power that you hold in this life stage, that you could use to your advantage, and ensuring that even in this life stage, the little changes that you can make have a huge impact at the ultimate end.
Oh, great. And so I think this probably all feels quite familiar. I don't think I need to explain how daunting this time of life is. We also played around with some friends memes. There are a couple of cases where Chandler and Ross basically look at the audience sort of squiffly and just say, what is going on, sort of thing. And so if you're feeling like that, you're in the right place. I think the first point that Sue and I would like to make, and I think this is quite a foundational one, is that when you are feeling like you're in this middle stage of life and all these responsibilities are coming at you all at the same time, both financial, emotional, health, etc., the most important aspect, of course, is to control what one can actually control. There's a lot of noise out there. If you watch ENCA this evening and tune into the news and that, there's going to be a lot of stuff there to stress you out. And there's a lot of things going on, generally speaking, but much of that really sits outside of your control. So when it comes to financial planning and thinking about your financial security and your financial future, we would uh, promotes the idea of really taking control of what you actually can control and what really matters. I mean, there's obviously a lot of things that you can control that don't mean a lot, but then the bigger things that really matter both now and into the long term. So I guess that's the first thing, Suzan, is just to really try and block out a lot of the noise and hone in on what you really can control. Okay,
Totally.
so what we've done in terms of this life phase is we have summarized 10 points, 10 ideas that are hopefully very practical and that you can start implementing and thinking about. And if we land only two or three, or maybe only one this evening, and you action that one idea, hopefully this half an hour or 40 minutes that you're giving up this evening would have been worthwhile. Suzan and I are going to take turns to go through them, and I might butt in from time to time and share my experience with them as well. And obviously, we'll take your questions and deal with that at the end too. So here you go. We'll put a couple up at a time, and I'll let Suzan tackle the first one. So these are the 10 coaching tips. I hope you've got your pen and paper available. Obviously, the recording will be made available too. Um, but yeah, let's see how
Thanks,
we go
Gareth.
through these, Suzan.
Amongst the things that you've mentioned that one can control, these you can actually control and use to your advantage to ensure that ultimately, when you look back to this life stage, you said, oh, at least I've achieved this part of what I could have made better. So the first one being automating your wealth creation. And this just generally means being intentional. So loading your debit orders and ensuring that it actually loads the next day, because you end up having the perception that it's your money when it's actually money that you should commit to your savings and your investments. And like Warren Buffett has always said, that don't save what is left after spending. Save spend what is left after saving. So to ensure that you are intentional in your saving and you actually get to the part of saving your money first and then spending the little that's left. And that will ensure the discipline also over time that will get you to where you want to get, Gareth.
Yeah. And I think that really comes down to when it's payday, so that might be tomorrow, that's the 25th, for instance. When you get into work that morning and you log into your internet banking and you just check that you have actually been paid, the amount that you see on the screen is actually net of the debit order that you've already put in for whichever RA fund you are contributing to, or tax-free savings account and so forth. And you've made that deliberate choice. And then when you start making other payments for whatever, it's after that fundamental payment to whatever savings scheme. Yeah. Okay, so that's the first thing, is get some debit orders going off your account before you can even touch that money. The second idea, which is quite a neat follow on, is to think about your saving and budgeting in time frames. So there's, obviously short-term goals, immediate expenditure that one has to look after. Some of that is grudge purchase that you know that you need to spend money on no matter what, like medical aid, some of your insurance policies, school fees, and so forth. And then you've got these non-negotiable long-term goals, which might be, for instance, a contribution to your pension fund. And then you've got medium-term goals as well. But by putting timeframes around these, it helps you articulate what your long-term goals are versus your medium and short-term goals, and start basically chipping away at these three buckets. I mean, bucket one might be used quite quickly because these might be uh, areas of expenditure that are coming at you in the next 3 months, but just ensuring that all the while, not everything is going into the immediate bucket. I mean, I think that's fairly obvious to say, and that you are provisioning into buckets two and three, three probably being the most long-term of all. And this can be a gradual thing. And I think very much like point one, the key thing here is to be deliberate in your thinking and your savings. So instead of having random tax-free savings account where you're putting 500 Rand a month into, what is the goal with that tax-free savings account? Is it your emergency fund? Is it something that's going to complement your long-term pension? Is it for a holiday that you've promised your partner in 4 years' time? And just sort of think about things, as I say, intentionally around these
Yeah.
different buckets. Yeah.
Yeah. And just to add to that, Gareth, not only will this benefit you in terms of structuring your financial plan, but it also helps you to not end up going into your retirement funds and withdrawing from your savings components, or going into retirement and retiring prematurely, because then you have your investments structured accordingly. You have your emergency funds where, if I'm stuck, I'll go there, and not end up going into a savings component where you tax ridiculously and then you lose that portion and you can't make it up. So it's really good to actually structure them nicely into those buckets. And then I'll just go into the third point, being controlling the lifestyle creep. And I think maybe being a bit younger, that's more of a risk in our sector, because you want to enjoy your life while you also want to be responsible and ensure that you do the right things and save and do the necessary things. But it's such a good thing when you see how, you looking back into your financial plan or your financial spending for a few months. Some people do it 3 months, others do it 6, others can actually do it in a month and be able to implement that and say, oh, I shouldn't have spent here. This is where I shouldn't do this or do that or add this. And like you said, Gareth, earlier, having to get into the stage and you realize that your parents are aging, or you become a dependent to more people, there's certain expenses that accumulate. And this is where you can actually look and have control to actually see where you're allowing lifestyle to creep, or there's responsibilities that have risen. So it's good to be able to look at your spending and see what you can cut, what you can reduce, like your insurances, for example, or your Netflixes. Do you need Netflix, Showmax? and DSTV. So it's things that you can look at in practicality and see if there's a need for all of them. And then lastly, the things you value, like I said earlier, you getting to a point where your parents are needing to be supported. So it's gonna need often trips home, or maybe you're gonna be sending more money home. And that's where you find value to say, do I really need Netflix, or do I really need to travel home to see my sick parents or my parents who need me? So it's good to have a reflection and look back, because then that helps you to slowly make those minor financial changes instead of waiting to see the mess after a year that, oh, I shouldn't have spent on this.
Yeah. And I think, the thing with lifestyle creep is often, when you move through your career from your 20s to your 30s and now I'm well into my 40s, you do get these bump ups in your salary along the way, and all of a sudden, before you know it, you've splashed out on a whole bunch of new lifestyle things that, in reality, you may not always need or have to have. And some of those might be once-off purchases, and others might be, as you say, Susan, sort of debit orders and things that you took out thinking they were a good idea, and maybe you had a bit of extra cash at the time. But as time goes on, actually, you don't need uh, quite as much. I think there's a lot of wisdom in this. And this is an idea that's come through in a lot of sort of financial planning books and articles. Is the idea around waiting 7 days before any big spend. You might go along, with your partner to check out some expo this weekend, and suddenly you see a new couch and you think, oh, yeah, that would be lovely. And before you know it, you've swiped a credit card and you've bought a new couch, whether you need it or not. So the idea here is just to, if you see a lovely painting or a new couch or a new car or something that you think you'd like to splurge on, maybe it's a wonderful idea, but give it 7 days and just let the idea settle a little bit before you go ahead and pull the trigger on it. And I also think, the idea that you had here, Susan, around keeping things that you genuinely value, I think that's important too, because you do need to live life at the end of the day. Not everything, life can't start when you're 65 and you decide to retire. You do need to enjoy yourself now. So as you're going through that debit order, if one, in my case, it might be the subscription to a sports club, for instance. And maybe it's even quite an expensive sports club, like a golf club, for example. Now that's, even though you might put yourself under a bit of guilt for that's a very healthy lifetime hobby that's
Mm.
fulfilling a whole lot of functions in your life, and probably shouldn't be the first thing you cut. There are a whole bunch of other things that maybe you need to cut first. So things that you genuinely value, they should stay on the list. Okay, so go into your bank statement, find the one thing to cut, and find the other thing to reduce, and you'll be grateful next month when those debit orders go off again. All right. Okay, moving on. Plugging the leaks. Here, there's this bucket analogy where every month, your salary comes in, or your commission, or if you're an entrepreneur, your income for the quarter or for the period comes in. And yes, you want to spend deliberately. We've just been talking about spending deliberately, but you also want to make sure that the inefficient spend is plugged. Those holes are plugged. And so once again, this means sort of combing through your bank statement and through some of your policies that you've taken out, and looking at where you can reduce fees, for instance, your banking fees, your insurance fees. Obviously, at ETFSA, we talk a lot about investment fees, moving from kind of high cost products to low cost ETF propositions is kind of at the cornerstone of a lot of what we do. But these leaks and fees are, around in different shapes and forms. It might be the type of debt package that you have taken out. Is one credit card and the interest rate you're paying on that credit card better than another? And just doing a bit of a sanity check around your affairs. And a big component here is tax. Now, tax can be a bit confusing, and a lot of people just sort of stick their head in their sand when it comes to tax. And I think there are two parts to the tax equation from a tax perspective, and Susan and I have dedicated a slide to that a little bit later on. But then just generally your general tax affairs, making sure that they're up to date, making sure that you are processing the right rebates and getting the right basically getting the right advice. And sometimes people feel like, no, I can do this myself, but there may be value in seeing a tax advisor, especially if your affairs, together with your lifestyle creep, have become more complex through time. I think it was Einstein who said that tax is the most difficult thing in the world to understand, and I think we sometimes feel like that.
Mm. No, certainly, Gareth. And I think with I think conversations like this, it's such an informative thing because most people, especially you say with your experience that a lot of people come with tax issues only at the end. Well, this is the time to actually have an overview, know your tax status, know what kind of product you should be investing in now, and not wait till you get to retirement and only then you're like, oh, actually, what's my tax status? What can I be doing? Or what advantages can I be doing to sort of advance my investment? So it's good to be able to actually plug into those leaks and make sure you use whatever advantages you have now. And I think the fifth point is certainly one of the most important points of all these tips because, I mean, without your income, you can't actually implement any of these tips. So, protecting your income is vital, especially if you in this specific life stage. This includes protecting your income through risk. So this is your disabilities and ensuring that you have income protection should anything happen. And as much as it's a topic that we don't want to all talk about, this is the stage where you end up you finding out chronics and this and that is not happening how it should in your body. So this is where you want to make sure you covered accordingly and you have all your corners covered. And together with that, you want to align this with your career risk. So this is not really so much a risk, but ensuring that your skill, you develop yourself consistently and making sure that you're not stagnant in the skill level that you have. Because together with that, it ensures that you are also financially growing in terms of income brackets. So ensuring that your income is protected not only in where you work and yes I have a job, but you ensuring that your skill is developing in line with that because then the skill goes well in together with you protecting this income because then if you're well skilled you forever have or be in an advantageous position in an economy like this. So it's good to be able to have the full understanding that together with having to implement these coaching tips, it's important that you consider your income and how protected you are so that you can implement these tips.
Yeah, and I think that last part is probably stressing everyone out already. How am I going to grow my career? How am I going to keep up this
Mhm.
level of growth? And there's only so much of that stress you can take on, really. But the point there is to try and have a growth mindset around these things and really don't what it is that you do as your foundational kind of form of income because the economy is constantly changing and evolving and yeah, that's never a good place to be as if you're too complacent. And I love the idea of having both a savings pot to fall back on
Mhm.
um, and also the insurance components to back up both from a health or in the event of death. All right, and then number six is around your actual investment portfolio and checking in on that aspect. Now, the people that we've invited onto this webinar have all got more than 10 years to go until they turn 60 or certainly 65. Now, 10 years is a long time in financial markets. You can pretty much weather any financial cycle over that period of time and eke out good returns that you should see from the equity markets, both global and local equity markets. So the point is, don't be afraid to make sure that your portfolio that's sitting in your retirement fund, whether it's your RA or your preservation, is well calibrated to the amount of time that you've still got to go until you retire. In fact, even when you do retire, you still need to have a healthy allocation to growth assets because your money needs to keep up with inflation and so forth. But especially now, you've got 10 years still to go. And
Mhm.
one of the things that we've been advocating for, and I've got another slide later on about this, so I won't dwell too long, is really to make sure that you've got the right allocation to growth assets, which is equities and property, and don't be too conservative in your portfolio.
No, no, I totally agree with that, Gareth. Just like Jake Bogle said, that the biggest mistake that investors make is not recognizing that their biggest advantage is time. And
Correct.
with a thing like managing your portfolio and making sure it works for you, is you realizing that in this life stage, you have time. So you can allow that to work to your advantage. And with that time, you are allowing yourself to also implement those little changes. Another person, the seventh point being increasing your contributions gradually. Another person would look at 1% and said, what's that? That's nothing. I want 5%. But having this 1% rule of increasing your contributions at 1% of your annual salary every year will make a huge difference. For, as much as it seems like a small percentage, but when you look at it overall, it will have an impact. And plus compounding. So if, let's say, for example, you earning 1 million, this 1% is 10,000 a year. So you'd increase your RA contributions with 10,000, which means that's 833 a month. And I mean, you go out and you spend more than that. So you can certainly increase your contributions by 1% every year.
And I think the good way of doing that, Susan, is to align it to your annual increase that you might get at work. So if you
Yes.
are earning that million rand for argument's sake, and your boss says, okay, good news, you're getting a 7% increase this year. Um, don't think of it as 7%, think of it as 6% because the 1% you're going to bank straight away as increasing your contributions to your retirement product. Ratchet up slowly, a pot is, and then it just becomes habitual. And when you look back at it, you've maintained, a healthy contribution rate. Okay. Um, point 8, I must be honest, I wrestled with a bit because it's this balance between how much do you invest in your children versus how much do you invest in yourself. Now, I come from a family of school teachers where kind of education was like the number one investment in the whole wide universe. So I'm not going to kind of talk people out of making sure that they don't invest too much in their kids' education because I think that's quite a personal choice, and some people are prepared to are prepared to sacrifice a great deal to give their children the very best education that they can afford. But of course, there are limits to this, and at the end of the day, your children are young. They're going to go out one day and have their own careers and make their own way in life. They're going to have access to credit and bursaries and student loans and a whole bunch of things that you also had access to. So, whilst
Mhm.
giving your children the best life that you possibly can and the best education you possibly can, I think the point is here is that that should come from a position of stability in your own life. It doesn't help to, pay for a whole lot of things for your kids if, ultimately they're going to end up supporting you in retirement because you haven't provided properly for yourself. And that balance can be quite tricky to get right sometimes because, as a father myself, as I say, you'd sometimes, sell a kidney to, do what you can for your
Yeah.
children. So balancing that can be
Yeah.
hard. Hey, Sue, I'm sure
Yeah,
you'd
no,
agree.
certainly.
Yeah.
Especially part of that feeling the responsibility that you have to more than anything, because you feel like if you're not, you're letting them down, or you sort of who else can do it if you don't do it. So
Yeah.
yes, it's a fine line of having to define where you draw the line to actually doing what you need to do and actually doing what you need to do for yourself. But certainly going into the ninth point is another one that you actually have to be able to know that buying an expensive house and using that as a retirement plan is not a good idea, especially because property is illiquid and undiversified. And it doesn't give you the flexibility should you want to switch or do anything. You're sort of stuck in it. And say the property market doesn't work to your advantage. Here you are stuck in this property that you wish to sort of retire now, but you can't because you can't sell it. So it's certainly not a good idea to consider a property as a retirement structured asset. So it's something that you should also start thinking about now. If you're already in a property that is ridiculously expensive, and don't get me wrong, I'm not saying don't buy your dream houses, ladies. You can, but don't make it ridiculously part of the financial plan at retirement. So yes, you can go for a nice house, but don't make it a ridiculous price. Then now at retirement, you're stuck with how do I survive
Yeah.
now?
I mean, at the end of the day, it's one single asset that's got a whole lot of things can go wrong with that one asset. The area can go down, interest rates can, whereas obviously if you're investing in a diversified portfolio inside your pension fund, you widely dispersed across the returns that you're able to get. All right, and then the last point is around again being intentional around doing this at least once a year. So, and obviously as financial planners ourselves, we have annual reviews with our clients, but you can also do this in your personal time around, sitting down maybe at tax year end, going through your bank statements and just saying, okay, where am I? Like, let's look particularly at my expenses. Has my lifestyle drifted more than my income can put up with, can keep up with? Last year I was going out for dinner 2, 3 times a month. This year, for some reason, I'm going out 10 times a month, and I'm doing this, and this, and I'm actually living a little bit beyond my means potentially. And again, just being deliberate with that budgeting process, and then also how that sweeps back to your investment portfolio. Is it still 10 years to go, or maybe it's a shorter time frame and so forth. And I think aligned to this is a more sort of philosophical aspect, and it's reflecting not just on your annual financial budget, but also your portfolio, and generally speaking, your work-life balance, your health, how you're thinking about overall balance and structure in your life. And I won't kind of go too far down that hole, but clearly your personal finances and your personal life and how you're balancing everything up go hand in hand at the end of the day. So it's an important thing for you and your partner, or you and loved ones, to go through on a periodic basis. Okay, so those are the 10 tips. I'm hoping at least two, three, four, five of those landed, and you're going to be downloading your 90-day bank statements in the morning and going through this list and thinking a little bit about that. The next part of the presentation is really from an ETFSA standpoint. So we've got four things that we wanted to touch on. There's all a bit of a tie back to those 10 points and the life stage in general. We're going to talk about our preservation fund offering. I'm going to let Suzan talk to that. Then we're going to talk a little bit about investment strategy at this time of life. We're going to talk about starting investments for your kids. You're probably thinking, guys, we just spoke about school fees. Do you really think I've got money to put towards my kids? But let it be their own pocket money. And then finally, looking at tax planning, which is around blocking some of those holes in the bucket. So Suzan will kick off with the preservation fund.
Um, certainly when we look at preservation funds, it becomes such a sore point because you find, Gareth, so many situations where clients have preservation funds, but they've left them almost dormant wherever they left them at, and they don't overview them. They don't check how it's performing. They don't switch. They don't know what the fees are, where they even invested. So it's become one of the focuses where we sat down with Gareth and we noticed how when you look at preservation funds together with retirement funds, but mostly preservation funds, it plays a vital role in your investment, long-term investing, because once you have this preservation fund, you invest it accordingly. Like Gareth said, you structure the asset allocation accordingly, you review it. This will actually work for you and actually make it worth it, because half the time you find clients get to retirement and say, please consolidate with my preservation fund, but you've left it wherever you've left it for almost 10 years with nothing implemented. For what it's worth, you've probably been sitting in a balanced portfolio for all those years and you've lost on growth, you've paid ridiculous fees and lost on anything that portfolio could have actually made for you. So
Yeah. And
it's
and and and
something.
s- and so here maybe it's probably worth reminding everyone what these preserved funds are in the first place. Very often, guys, here we're talking about, remember that job that you had 8 years ago where you worked there for 1 year, you joined their pension fund, then you didn't really like the place and you moved somewhere else and you decided to preserve your money with that pension fund and leave it behind. Now, very often we find clients who've got two, three, four different preservation funds dotted around with past employers. Some they've tried to tidy up and move into one place, and others they've just left for ages.
Yeah.
Yeah,
And what's worse is that when it's in within a fund, even worse, the trustees decide for you. So you don't even have the discretion to decide where you invested, how you invested, whether you want to switch when you feel like equity market is working or the equity market is down, let me move in. You can't have even that. So this moving into a preservation fund or moving your pension or your provident fund in the preservation fund is you retaining your rights and retaining the power that is in you to actually work on this investment and make decisions on this investment. And what better than having this kind of structure where the fees are low and you know the performance is there. And I mean, once you do that and it's in a nicely structured asset allocation, now I can comfortably say you can sit and do a review once a year, then leave it for 10 years.
yeah,
So it is one of those focus points, Gareth, that it's good to sort of look into this, because I'm almost sure 50% of the listeners today do have pension funds, do have provident funds. Others even do have preservation funds. And my question to you is, when last did you review it? What are the fees on it? How
yeah.
has it been performing? So if you can answer those questions, then perfect. But if you can't, then I think it's a time you contact us and we can help you review it. Check how it's
Yeah.
performing. Are you nicely structured for your age, for your stage? And from there, see how we take it from there.
And I
And
think
such,
and I think this, sorry to interrupt, Soon. I think this stage of life is critical to do that because, for a long time through your 20s and your 30s, you don't think too much about these employer arranged pension funds. You just kind of, it's going off your salary slip type of thing, and you don't overthink it. But now suddenly in your 40s and into your 50s, you've changed jobs a couple of times. And so these little buckets of savings are building up and accruing. And this is
Mhm.
precisely the tidying up and consolidation that you're talking about.
Yeah, and I know a lot of clients will come and say, but how does this play into my financial plan? Should I immigrate or should I be stuck and I need a withdrawal? Your preservation rights still remain. So you still have the excess of your once-off withdrawal. Should you immigrate, you still have access to actually withdraw the total of that investment and use it maybe for immigration or costs that are incurred when you immigrate. But it still gives you that flexibility. The only difference with actually consolidating or moving it is you having the rights and certainly low cost and the diversification that you can get within the portfolios we offer, and the transparency. Anytime you can log into your, I mean, your I talk about retirement funds and living annuities all the time. You can actually log in anytime to a preservation fund, review it, see how it's performing, switch when you need to switch at no additional cost. So it gives you actually the power that one needs
Yeah.
in an economy
Right.
like
And
this.
we at ETFSA have basically just relaunched our preservation fund offering. You'll see a blog about it on our website. Many of you might already be members of the RA fund, but have got preserved assets elsewhere. So we've got yeah, as I say, a relaunched preservation fund. It's the same portfolios that we offer within the RA, similar sort of cost structure, 0.95%. And Suzan remains your kind of go-to person in terms of retirement planning and helping clients, move between different pension funds and consider all of their options. The biggest thing, of course, with this product wrapper is that you retain this once-off lifetime right to withdraw from it before retirement. So if something catastrophic does happen in your life, you're retrenched, your house burns down, you get divorced or something like that, and you really do need access to these funds, then you're allowed to access them pre-retirement, so pre the age of 55, and you've got that flexibility. Okay, so yeah, so you'll see a lot of new information on our website around our preservation. As I say, the blog, there's going to be some more communication about it. But if you need to set up time with Suzan or I around kind of the whole idea of preservation funds, what it's all about, yeah, please do reach out to us. Okay, then moving on to investments and asset allocation. And here I wanted to spend a bit more time on the point that I made earlier around having 10 years to retirement. Now, interestingly, often when people think about financial planners and our role in life, it's around making sure that clients don't take on undue risk. They don't put, you know, all of their money into Bitcoin for argument's sake, and they don't disinvest at the bottom of the market, or they don't, consider a Ponzi scheme that sounds too good to be true. So a lot of the time, it is helping clients navigate away from silly investments or investments that may carry too much risk. Other times, believe it or not, it's about encouraging clients to take more risk. And when you have 10 years to retirement, the important thing is actually to make sure that your portfolio is working hard, that you are in asset classes that are going to give you the most amount of growth through time. So now when we refer to growth assets, we're talking about equity and to a lesser degree listed property. So when you look at our preservation fund or our RA fund, you'll see this whole range of products. There's six in total, and they range from low risk through to high risk. Now we would encourage our younger clients and those on this call, whether you consider yourself young or not, to be in a higher risk portfolio. Now, it does also mean that you shouldn't look at your statement every month, because if you look at your statement every month, you might get a few frights along the way, because a high risk portfolio in this context, or a high growth portfolio, is going to be more volatile. So it's going to be a little bit more uncomfortable in terms of your balance month in, month out. But I would argue that you shouldn't be looking at your pension fund balance month in, month out, and you should be letting it just ride through time. So at the start of last year, we launched a new portfolio that we call the Velocity portfolio. And the goal with that portfolio is basically to, within the pension fund rules, so remember the pension fund rules make sure that pensioners are well diversified no matter what. Within the pension fund rules, you're still able to invest 90% of your money in growth assets and only 10% of your money in defensive assets, which is basically bonds and cash. Now, obviously, there are times where bonds and cash outperform equities and growth assets, but very, very, very seldom does that happen over a 10-year cycle, like hardly ever. So it can happen, but it's very unlikely. And because it's unlikely and there's the statistical probability that you're going to do way better in growth assets over a long period of time, we want our clients with a long time to go to max out their exposure to that type of portfolio. So, like Susan said earlier, please, make use of the time that you have available to save for retirement. And if you're already a member in our fund, consider chatting to Susan around your portfolio choice. And yeah, and we can take it from there. I don't know, Susan, was that clear enough? I don't know if you got any comments to add. Yeah.
It was totally. And also remember, just to add a point to what Gareth just mentioned, is that should you want to consider to move your preservation or your pension or provident fund, I can assist you with the whole process at no additional cost. So we can review it for you and actually do a proposal if necessary. And we can also do the transfer from that specific insurer or the specific fund without you getting involved. The only time will you get involved is signing, but otherwise we can help you with the whole process.
Yeah. I suppose the biggest mistake people make here, Susan, is that they they look at their portfolio at a time where markets have just done poorly. You have a bad year in financial markets, and they're sitting in a high growth portfolio. Let's say our enhancer portfolio, which is actually our biggest portfolio.
Mhm.
And then they look across at the conservative portfolio and they say, but hang on, last year these conservative portfolios did better. Why am I not in a conservative portfolio? I'm going to move to the conservative portfolio. And guess what? That's at exactly obviously the wrong time. It's just a bad decision.
Mm,
And you really do need the markets to work for you through time. And that's really the trick, is to ride those market cycles. Okay.
totally.
I won't dwell on it any longer. Okay, moving back to you, Susan, and saving for kids and so forth.
Yeah, so together with this, we as financial planners always say that when you look at investments, you don't just look at them isolated. It's different products playing together. And this comes together ultimately at the end where you don't only retire with retirement annuities and pension or provident preservation funds. You also need a discretionary investment. And here and there, you need a wealth managed portfolio for those that actually can. But having a balanced, structured financial plan is the way to go. So together with that, here is a dynamic tool that even parents listening today can use for their kids. And this is tax-free investments where you can invest for your child. Others use a tax-free investment to invest for specific goals. I know the other day we got contacted by a client who wanted to save for varsity fees. What better product than tax-free? Everything is tax-free. Growth you make is tax-free. There's no capital gains, there's no interest income, there's nothing charged on there tax-wise. So how better than use this kind of tool to save for your child, not really necessarily for a specific goal. You can also save from when they're born. And ultimately, when you need the money, withdraw it tax-free. So together with that, remembering that the limit also went up this year, you want to use it and make sure that you max the 46,000 because it wasn't 46 before. And you have the lifetime limit of 500,000. And having to have this, even starting as little as 300 per month, if you can. Like Gareth was saying, you need to be intentional about it. And once you start, which we always say as professionals, that it seems the starting point is the hardest. And if you can start at 300, you can increase it gradually. Or if you have that lump sum that's sitting in your money market or your savings account, put it in your tax free, see what it can do for you. And in the tax free, you have exposure to all kinds of ETFs. We also have model portfolios that are nicely structured in terms of risk, in terms of return, and they focus because now not only are you investing in one ETF, you have a portfolio that is structured to actually invest in more than one ETF in this one model portfolio. And it can work to your advantage. So again, I think to get this together with your retirement fund and preservation funds, you certainly set for retirement.
Yeah, and I think when we put the idea of having this slide there as well, Susan, we also wanted to encourage everyone to get their kids stuck in, and you can either do it for your kids, or I would actually encourage you to get your children actually engaged with this, and it's a wonderful financial planning conversation, and it goes a little bit like this. You have a weekend with your children, and basically they wake up and they put Netflix on. Hey, kids, wouldn't you like to be a shareholder of Netflix? Oh, it sounds like a wonderful idea. Then you sort of get them a little bit fired up. Lunchtime, you find yourself in McDonald's. Hey, guys, wouldn't you like to be a shareholder in McDonald's? Oh, I'd love that. Okay, fired up again. Then they get their Coke at the McDonald's. Wouldn't you like to be a shareholder of Coke? Oh, I'd love that. And then they go off to their soccer party and they play, with a Nike soccer ball. Wouldn't you like to be a shareholder of Nike? Yes, please. Well, guess what? You can with like 300, oh, and then in the evening, like Disney Plus or something ridiculous. All of those stocks are available in like a very simple S&P 500 tax-free savings account on the ETFSA platform. So it's a wonderful way for you to start something for your kids, start the financial planning conversation, and so forth. Okay, and then the last conversation tonight is just around tax, and then we're going to have some questions. And we did have a tax seminar at the start of the year, so I won't dwell on this too long. And also, we've chewed up a lot of our time, Susan. But it's just to remember to, when you have your chat with your tax practitioner, just make sure you're keeping all of this stuff at the top of mind. How much are you allowed to invest in your pension fund every year so that you still get the tax deduction? That's just gone up to 430,000, which would be, an amazing amount to put aside every year if you can afford that. Um, your all of your movements between portfolios, like we spoke about earlier, happens in a tax-free sort of way. You can move from one provider to another. The tax-free savings account, we've already spoken about, a 46,000, which was increased from 36. And then from the CGT perspective, from a capital gains perspective, there was a small increase as well during the course of the year. So we're not tax practitioners per se here at ETFSA, but we are certainly tax aware in terms of how we give advice, and we do guide clients as much as we can around being sensible, certainly with the investment side of their portfolios, to make sure that they're managing tax appropriately. Okay, so hopefully between the 10 points and the ETFSA specific stuff that we touched on at the end, we've fired up a few lines of thoughts with you guys. So I'm going to go to the questions, Sue. I'm going to try and manage the Zoom account here. I might stumble. So I've got a few questions coming through. And thanks, everyone. I hope you found that useful. So the first one is around, yeah, Susan, I also thought you were very sexist. I think the moms also enjoy watching the soccer, just by the way. Not just us dads watching it. Okay, then. So here's a question. I currently invest in a few ETFs, some of my tax-free savings accounts and some of my investment accounts. As a middle-aged person, what type of ETFs should we focus on at this stage of our lives? So I think here we spoke about those buckets. So let's think about which bucket you're using the tax-free saving account for. If it's an emergency fund and you might need this money within the year, then you need to be in a income generating portfolio. But as soon as you're talking 3, 4, 5 years or more out, then you should be taking some risk. You should be we've got on the hub, we've got an equity model portfolio, we've got a balanced portfolio, and we've got an international portfolio. And all of those are perfectly good for long-term savings and for a middle-aged person. I would maybe check the timeline exactly what we're talking about here with your tax-free savings account. But yeah, make sure you've got some growth in there. You're welcome to reach out to us and we'll talk more about that. By the way, we've got some very exciting stuff coming up on our website in the next few weeks, and yeah, watch out for that. All right, the next question is how often the asset allocations or the rebalancing takes place in the RA. Susan, maybe you want to deal with that in terms of how it works inside the RA fund. How often should portfolios be reviewed and rebalancing take
When
place?
not only on the RA, but on your overall investments, like Gareth mentioned earlier, doing an annual review is enough. Unless there's really a necessary switch that you need to do. But certainly doing an annual review, and not just an annual review on one investment. That's also another part. Doing an annual review on all your investments, because like when you look at investments, you don't look at them isolated. You look at them overall so that you don't end up duplicating somewhere or end up being invested in the same asset class. So it's good to do a full overview and be able from that point determine whether you need to switch or not.
Yeah. All right, then a question around if I cash out my RA at 55, can I put the proceeds into the Velocity portfolio? You absolutely can, but you can also remember the Velocity portfolio is available even before you're 55. So yes, you can have an investment in the Velocity portfolio pre-retirement age, post-retirement age. If
Mhm.
if after the age of 55, you're going to suddenly start drawing down on that capital at some sort of quite high withdrawal rate, then that's not going to be the ideal portfolio. Then we need to start de-risking it slightly and moving into a portfolio that's got more fixed income and more defensive assets to ensure that we can pay out that annuity in a sustainable way. But there's no reason why at the age of 55 you can't invest in the Velocity portfolio. And we have it in a number of different ways. Yeah, so yeah, absolutely you can. Another question, does ETFSA offer an endowment product? It's from Selwyn. Selwyn, it's not part of our mainstream product offering, but the short answer is we can do it. We make use of one of the platform partners that we have in the market, which is Wealthport. They have an endowment wrapper that we can make use of. And the same ETF model portfolios that we offer, like on our website that you'll see there, can be made available if you'd like to commit your money for like a 5-year period and take advantage of that tax. So it's not part of our bread and butter offering, but we certainly can do it for you. Okay. Question from Lita. Please share your contact details on the preservation fund. Lita, it's all available on our website. If you go onto our retirement page, you'll see there's a specific contact form for the preservation fund. You'll find it all over the website. Suzan or someone from the team will definitely come back to you about that, and we'd be delighted to help you with that. Okay, then another question from Selwyn. How do you propose to fill up the various buckets in the three-bucket strategy? E.g., if I've depleted bucket one and the market crashes, I can't then replenish bucket one without taking a hit on buckets two or three. Yeah, that's a good point. So, I guess the point with bucket one is that it's your emergency fund. So that fund that Suzan put forward of, say, 2 to 3 months of monthly salary. And that's really, it's supposed to cover you if, I don't know, you have a car accident and you need to buy a new car and, suddenly you need to come up with 100,000 Rand or something like that. Um, um, and being deliberate with, okay, what if there's a life event in the next while? I might need access to this bucket, but all the while making sure you're investing towards your retirement bucket. Then when
Mhm.
you are retired, it's kind of the reverse sequence. We have some of your money in growth assets and some in defensive assets, and then we pay out your annuity from the defensive component. Yeah, I don't know, Susan, have you got more you'd like to add to that question? Yeah.
Yeah. And so someone you still also have an option that should you deplete your savings bucket and you reach in retirement, you do have an option to also at retirement take a lump sum. It's good not to consider it starting to plan because then now you don't save and you expect that retirement to get this lump sum tax free. Because as a South African, you have 550 that you can actually take tax free. But remembering that should you take this, it's once a lifetime. So you can also have this as an option when you get to retirement. If you've depleted what you've saved over this time, then you take that lump sum and then now you reinvest it. When you have those hiccups, then you can go into this and use that.
Yeah. Okay. Good, guys. I think we up now in terms of our full hour that we'd set aside to chat with you this evening. please do email us and let us know what you thought of the discussion tonight. As you can see, it was a bit different to our usual sort of style. And we're also trying to gauge whether this is the right time of day to have these sort of things. We polled our investors the other evening, and actually, I was completely wrong as to when everyone would like to have these things. So it turns out 6 p.m. is a popular time, but if you'd prefer to have it over lunchtime or whatever, let us know as well. We're still assessing that. But it's been a great pleasure to talk to you this evening. Susan, it's been lovely to have your company. Susan, by the way, has been helping me with my own financial planning studies. I come from an asset management background, so I've had to skill up myself on some of these things. And Susan is the professional coach in the office on all these things. So, you really are in very capable hands with her. Great. Thanks everyone. I really appreciate it. And yeah, feel free to email us and phone us anytime soon.
Thanks, guys. Thank you,
Thanks.
everyone.
Thank you. Bye bye.
Bye.